Ever wonder who actually runs the economy in the background? How does the interest on your loans, the cost of your groceries, and even your ability to obtain employment get shaped by decisions made in private, silent boardrooms by a small group of people? You might be surprised to learn that the central bank, not the government or large firms, is one of the most influential organizations in every modern economy. Their actions have an impact on every aspect of the financial industry, even if they don't sell goods or generate news every day. We'll explain how central banks manage the economy today, the significance of interest rates and quantitative easing, QE, and how you're affected by all of this. A central bank. What is it? All other banks essentially use a central bank as their bank. Ordinary people like you and me don't benefit from it. Rather, it addresses the government, commercial banks, and the financial system as a whole. Its primary function? To maintain economic stability. Here are a few well-known examples. The U.S. Federal Reserve, commonly referred to as the Fed, the Central Bank of Europe, ECB, the English bank, the Japanese bank. Consider them the financial referees. They set the rules and ensure that the players don't damage the field, but they don't play the game. Three primary missions are the focus of most central banks. Price stability is the ability to regulate inflation or rising prices, ensuring that as many people as possible who desire jobs may obtain them is known as full employment. Preventing financial crises and bank failures is known as financial stability. Your money will not purchase as much if inflation is too high. People reduce spending when unemployment is high. Everything comes to a complete stop if the financial system fails. Balancing all three at once is a task for the central bank, akin to balancing blazing torches while riding a unicycle. Central banks employ two primary categories of instruments to accomplish those objectives. Conventional instruments, including as reserve requirements, open market operations, and interest rates. Unconventional instruments, such as forward guidance, negative interest rates, and quantitative easing, QE. Let's simplify these by breaking them down one by one. Interest rates are the economy's master lever. The cost of money is interest rates. By altering interest rates, the central bank is adjusting the economy's thermostat, either making it hotter or colder. When interest rates are raised by the central bank, it costs more to borrow money. This implies mortgages and loans are more expensive. Companies postpone growth, customers save more and spend less. This lowers inflation by slowing down economic activity. It's similar to applying the brakes when the economy surges. When interest rates are lowered by the central bank, the cost of borrowing goes down. This implies businesses are investing more. More commodities, vehicles, and homes are purchased by consumers. Demand rises, which accelerates economic expansion. When growth is too sluggish, this is like stepping on the gas pedal to accelerate things. What impact does a little rate adjustment in a conference room have on the economy as a whole then? The so-called monetary transmission mechanism is how it operates. Changes in the central bank's policy rate or the interest rate at which commercial banks borrow from it have an impact on other banks. Businesses modify their investment plans, banks modify their own lending rates, and consumers modify their spending and saving habits. To put it briefly, reduced borrowing due to higher rates results in slower growth and reduced inflation. Reduced rates lead to increased borrowing, which accelerates growth and raises inflation. The effects ultimately spread to every coast of the economy, much like when a pebble is dropped into a pond. Open market operations, or OMOS, are another traditional tool. Central banks use this method to inject or withdraw funds from the financial system. They accomplish this by purchasing or disposing of bonds and other government instruments. The analogy is as follows. Think of the banking system as a huge pool. By purchasing bonds, the central bank is increasing liquidity and bringing down interest rates. It is draining water when it sells bonds, which tightens the supply and raises rates. Why QE is used by central banks? Reduced long-term borrowing costs. Central banks can lower yields and raise bond prices by purchasing bonds. Promote lending and investment. Low-cost funds facilitate borrowing for businesses and consumers. Encourage financial markets. Increased asset values, strengthen balance sheets, and restore investor trust. Influence expectations. It conveys the central bank's dedication to assisting the economy. The worldwide financial crisis of 2008 saw the U.S. In order to stabilize the system, the Federal Reserve started enormous QE initiatives, purchasing billions of bonds. The European Central Bank and the Bank of England did the same. Additionally, in order to avert economic collapse, during the COVID-19 pandemic in 2020, central banks all over the world once again launched massive quantitative easing operations. These actions helped economies recover, kept markets afloat, and avoided widespread bankruptcies. But they also generated fresh discussions about inequality and inflation. Like any potent medication, QE has adverse effects. It has the potential to raise asset values, resulting in stock or real estate bubbles. Because wealthier people often possess more financial assets, it can exacerbate wealth disparities. It has the potential to raise central bank balance sheets to dangerous heights. To put it another way, if QE is abused, it may result in long-term problems even though it can rescue the patient. At times, a central bank's words can have just as much impact as its actions. When a bank expresses its future intentions regarding interest rates or policy actions, this is known as forward guidance. Businesses and investors can make plans appropriately. For instance, if a central bank pledges to maintain low interest rates for the ensuing 2 years, it's comparable to a weather forecast for the economy in that individuals are more inclined to invest if the skies are clear for a while. Effective forward guidance increases trust and lowers uncertainty, which improves the effectiveness of other instruments like rate changes and quantitative easing. In order to affect the value of their own currency, several central banks also buy or sell it in the foreign exchange markets. Why? Since both inflation and exports are impacted by the currency rate. A rising currency makes imports more affordable, which lowers inflation but hurts exports. If it declines, imports become more expensive, which drives up inflation, while exporters become more competitive. Particularly for nations with controlled or set exchange rates, it's a fine balance. Imagine it like tuning a guitar string. If it's too tight or too loose, the entire melody will be lost. The authority of a central bank is largely dependent on independence and confidence. It may print money to win elections if politicians control it, which would lead to a sharp rise in inflation. However, it can choose long-term stability over short-term politics if it is independent. Because of this, the majority of contemporary economies shield their central banks from overt political meddling. It's similar to having an impartial referee who can make the difficult decisions necessary to maintain fair play. Central banks are powerful, yet they are not able to solve every problem. They are unable to address systemic issues, including global supply shocks, automation, and inequality. Additionally, occasionally, their techniques simply don't work, such as when organizations or individuals are too careful to borrow money, even at low interest rates. When money is inexpensive but not being used, economists refer to this as a liquidity trap. For this reason, fiscal policy coordination with governments is essential. The economy runs smoothly when fiscal and monetary policies cooperate, with one controlling the steering and the other applying the gas. Who is in charge of the economy then? Although they may not have complete control, central banks have a huge amount of influence. They influence confidence, direct the flow of money, and stabilize economies during times of crisis through communication, QE, and interest rates. They can be compared to the economy's invisible hands on the steering wheel, modifying direction and speed to keep it on course. Therefore, keep in mind that the Fed hiking rates and the ECB purchasing bonds are not only theoretical actions the next time you hear about them. Your future, your career, your money, and your mortgage are all shaped by these decisions. If this was useful to you and you'd like to learn more about how central banks, markets, and money affect your life, stay ahead of the economy by subscribing right away and pressing the notification bell. Because it's not just economists who need to grasp how central banks operate. Anyone who wishes to comprehend the world we live in should read it.